Hi all, I'm Akshara Menon from PMS Bazaar. It's an absolute pleasure to welcome you to today's webinar on a fascinating topic, quant investing versus traditional PMS. Can quant beat human intuition? Before we dive into the discussion, let's briefly understand what quant PMS is all about. Quant PMS is an advanced investment strategy that relies on quantitative models, algorithms, statistic techniques. This data driven approach helps to identify opportunities, optimize portfolios, and manage risk effectively. Unlike traditional methods, quant PMS minimizes human bias by leveraging the automation to ensure the consistent objective performance across varying market conditions. Now that we have a basic understanding of what quant PMS is, let's talk about what you can expect from today's session. This webinar will explore how quant strategies have potentially outshined the traditional PMS. We will delve into Estee Long Alpha's unique approach to investment, to which consistently they delivered exceptional growth. You'll also learn how quant models process vast amounts of data with speed and precision, ensuring more accurate investment decisions. Additionally, we'll also uncover how the sector agnostic approach to portfolio construction helps to balance diversification and growth while minimizing the drawdowns. Finally, we will see how adaptive models have designed to tackle volatility and uncertainty, ensuring the consistent returns in today's ever-changing markets. To help us to navigate through these topics, we are honored to have Mr. Vivek Sharma. Vivek Sharma is an accomplished graduate of IIT Kharagpur and currently serves as a Vice President and Investment at Estee Advisors and Gulaq. With over a decade of experience trading international markets at Futures First, Vivek played a key role in establishing their energy trading desk and trained countless successful traders, making the significant contribution to team's growth and success. I'm sure his expertise and insights will make today's discussion very engaging and thought-provoking. Welcome to the show, sir.
Thank you, Akshara. Thanks a lot for having me.
So without further ado, let's begin. But before that, I would request the participants to put their questions on the Q&A box out there. Thank you, sir. Over to you.
So broadly, I'll be speaking about these four topics. One is a brief introduction about me and the company. Then we'll touch upon the quant versus traditional investing discussion. I'll then take everyone through the long alpha quant PMS that we have been running for 5+ years, and finally Q&A. Right? So now Estee is a pioneer in systematic investments in India. Way back in 2008, when algo trading was just getting formalized and being launched by exchanges, at that time Estee was founded with the idea of running quant driven trading and investment strategies, right? So currently we are operating or trading in 6 countries. We have also been awarded NSE Institutional Member of the Year, and we are managing now close to more than 1,500 crores currently. Yeah. ST was founded by Sandeep Tyagi. He's an alumni of IIT Delhi and also have an MBA from Columbia University, and he has 30+ years of portfolio management, analytics and consulting experience. I am a BTech and MTech from IIT Kharagpur, and I have about 20 years of experience in trading international markets also and in the quant investment space. So let's start with our discussion. So quant versus traditional, I think quant is a hot topic these days. A lot of mutual funds, a lot of PMSs are being launched on the basis of these quant strategies. So here I just want to touch upon the differences between a quant investing approach versus traditional discretionary investing approach. Now, I'm not trying to essentially suggest that quant investing is better, but there are some very key differences between quant and the traditional investing. So quant investing purely relies on a very systematic rule-based approach. You take in tons of data, historical data, and you have some hypothesis. Hypothesis could be, let's say, some of the basic thing could be, let's say, if a stock has risen in last 1 month, what is the next 1 month returns? I believe it should be higher, right? So that is one hypothesis. You take that data, backtest it, and it's a very, very systematic and rule-based approach. Whereas traditional investing relies more on subjective analysis and judgment. And to an extent, that is why maybe traditional investing would do better in times where there are crises like COVID, right? So that kind of crisis, a quant investing approach might not be the best approach, but in normal times, quant does outperform, and I have some data to share. Quant investing eliminates the human biases and emotions. Now, this is again a very, very strong positive in the favor of quant, that it really eliminates the biases that anyone, all of us have our own biases, be it towards a specific stock, it could be a favorite sector that we have, right? And this is one of the negatives with the traditional investing, that they are influenced by emotions. Not obviously not everyone, but many fund managers are influenced by their emotions, by their biases. And investing utilizes advanced algorithms and technology, whereas the traditional investing, it involves manual evaluation of financial metrics or competitors. Whereas all of these matrices are also analyzed by quants. It's just that we use a lot of data to do competitor analysis, or even the financial metrics. If you see, almost all the financial metrics is nothing but raw data, right? So you take that raw data, put it into these algorithms, which will make sense of uh, these these data, right? So these are the key differences between quant and traditional. And I just want to now, quant and factor, they are used interchangeably. A lot of factor funds are being launched currently, and here I've just captured the Nifty 50's performance as compared to these four most popular factors, which is momentum, value, low volatility, and quality. And if you see last 13 years of CAGR, obviously each has its own ups and downs, but if you look at the CAGR, which is given in the last column, you clearly see that all of these, barring quality has just given equal returns as Nifty 50, but others, all three, momentum, value, low vol, have clearly outperformed over this 13-year period. So this is, I think, clear indication that these factor indices or these quant indices do work over long run. Obviously, during individual periods, they have their own ups and downs. Another thing is, I've just captured here the performance of our long alpha, which is a multi-factor methodology, which captures all of these four factors as well as multiple other factors that we use, which I'll be speaking about in the next few slides. So this is, I think, it's a clear indication towards the strength of these factor performances, and that is why we see a lot of mutual funds now getting into this space. And also, obviously, you have quite a few PMS also now who are launching quant-based funds. Now, so to speak of the benefits of these quant models, as I've spoken about, very clear, transparent, data driven approach. It is the consistency of these this specific approach. So whatever your rules are, you follow it consistently across ups and downs, across different market conditions. Thirdly, benefit of quant model is into risk management. You know clearly why your specific strategy is underperforming or outperforming. You have a very, very clear indication as to which specific factor, because of which specific factor you are losing money, and how much you are making money, and because of which specific factors. You can obviously, you do back test, and that gives you a very good indication about what to expect from these quant strategies. So you have very good idea about how these strategies have performed in bear markets, in bullish markets, or in multiple market regimes, right? And finally, you are able to cover the whole market comprehensively, because computers are able to analyze these tons of data, which humans really can't in such a short period of time. Uh, and because of that, we are able to cover the whole market very comprehensively in much shorter duration. Okay. So next, let me just quickly take you through our Quant PMS. The name of this Quant strategy is Long Alpha, and it has about now 6 years of track record. Okay, so it's a directional strategy which is designed to consistently outperform the benchmark equity index while maintaining low volatility. Now, here our focus is equally on the risk, which is to maintain its low volatility as well as on the outperformance or generating alpha. So we do take into account what's the volatility of our portfolios and how we can keep it low across different time frames and in different market regimes. The management style is it's purely quantitative. It does not have any human interference. It implements a systematic rule-based trading model to eliminate the human subjectivity. Now, this has worked well for us in the past that we have been totally hands-off in our portfolio construction approach. Obviously, we do work a lot on improving these models, but when a model is being used in practice and whatever portfolio it suggests, then we do not apply our own judgment because we are our skill set is in designing these models and not picking stocks on our own, right? Now, investment process, it's quite clear. It identifies investable businesses from S&P universe using a blend of technical and fundamental. I think, Akshara, one of the major myths about quant investing is that it only takes into account technical factors and fundamental factors are ignored. Now, this is not, excuse me. Now, this is not really true because a well-designed multi-factor quant strategy does take into account technicals as well as fundamentals into its factors, right? And finally, portfolio optimization. Now, you can actually uh, optimize your portfolios on multiple parameters. It could be that irrespective of the risk, you want to design a portfolio which gives you the highest returns, or irrespective of returns, you want to design a portfolio which is the least volatile, or it could be a mix of both. From our perspective, what we have tried to design is to have the highest risk adjusted returns in our portfolio in this specific long alpha strategy. Okay, this is the performance since about Jan 20. So about 5 years of performance. Uh, and it clearly shows how we have been able to outperform both Nifty and BSC over the past 5 years. Pretty much that is when strategy was launched. In May 2019, we launched the revamped version of Long Alpha, and since then, uh, we have had a pretty good run actually. Now, I'll talk a bit in detail about our portfolio construction approach. Now, there are multiple building blocks in this approach. So, on the top, we have this dynamic factor combination. Now, factors are anything that can affect a specific on the basis of which you actually select stocks. So it could be value. Now, value is one of the most popular factors, and there are many funds, and they are discretionary in nature, being run by mutual fund managers who focus exclusively on picking undervalued stocks. Now, that is what they are in essence doing is they are picking undervalued stocks. So they are using value as a factor to construct their portfolio, or it could be quality, or it could be momentum. Now, momentum is a very technical indicator. What it does tell is that if you, let's say, sort all the stocks that are in your universe on the basis of their last 6 months returns, and you pick the top stocks out of that. So your hypothesis is that they'll continue to outperform in the near future as well. So if you're doing something like that, you're using momentum as a factor to pick stocks. And momentum is obviously one of the strongest factors that we have seen across market regimes and across geographies have worked well. Now you combine all of these, and why it is dynamic is because you use multiple regimes to actually vary the weight of these specific factors. So they're not being used uh, all the time, but it depends on the market regime, whether you are using and how much weight you are actually allocating to these factors. Now, the second building block is index reconstitution. Now, any index, let's pick Nifty 50, if a stock is getting included in it, lot many investors and even institutional investors or index funds who are tracking that specific index are going to buy that specific stock. So there's going to be a buying pressure in that. And if the stock is getting excluded, that has a certain negative bias because people are trying to get out of that stock. Right? Then they are very smart institutional investors, be it mutual funds or be it FIIs, who are buying or selling a stock. So in this specific block, we also do keep a track of what these institutions are dying and doing and where the demand is of which specific stock these institutions are really buying that stock. Then the second last block is the sector or industry rotation, because in multiple market conditions, in different market conditions, different type of industries or sectors work, and then we take that into account and figure out what specific sector we should be in and what specific sector we should be underweight. Now that we use along with dynamic factor combination to figure out what stocks we should be buying. And finally, we have this market microstructure, which tells us on the daily basis the buying and selling pressure or the data from options or from futures. What is that data telling us? So all combined, these we have about 130 micro strategies. Now, individually, you can use any of this micro strategy, and people do use it to actually construct a portfolio. It could be purely on the basis of momentum. Now, we have seen a lot of funds out there who could purely rely on momentum to pick these stocks, or it could be purely, we know there are funds who are purely on the basis of value as a factor, right? Now we in Estee don't have any favorite sector, we don't have any favorite factor. We use all of these 130 micro strategies, and in the next phase what we do is we use regime estimators to figure out how much of weightage I should give to each of these factors. Now, what are these regime estimators? We track almost 9 macro factors using which we try to figure out what regime we are in. So these factors could be like GDP growth rate or prices of essential commodities like oil, or it could be inflation, it could be interest rate curves. These we track 9 macro factors using which we try to determine what is the regime of market we are in. And in this specific regime, out of these 130 micro strategies, which are the strategies that are most likely to work. And that's how we construct our long only portfolio, long alpha portfolio. And obviously, there's an element of risk assessment here. We do take into account how much concentration there is there to each sector, to each stock. We do take those things into account while constructing our portfolio. And as I've said earlier, what we try to optimize on is the best risk adjusted returns. These have been our since 2018. This is the yearly performance. So if you see, since revamp, we had a major revamp in May 2019. So for the first 6 months or so, 6 to 8 months, we were running a single factor methodology. And in May 2019, that's when we transitioned to this specific multi-factor methodology. So if you see our gross returns since May 2019 in the table below, it is shown that we have produced close to double that returns of S&P BSE 500. So roughly around 32% versus the 17% in BSE. But the important thing here to note is, although we have given very good alpha of 15-16%, but it has not come at the cost of volatility, right? Here, our standard deviation, which is a measure of volatility, is actually lower than that of BSE 500 during this time, right? And if you see the maximum drawdown, also the maximum drawdown in this strategy has been 17.7% versus 30% in BSE 500. So it's not only that we have delivered good alpha. I think most of the many funds have delivered very good alpha in last 4 5 years. But the important point to consider is also that what's the risk you have taken to deliver that. If you have constructed a very concentrated portfolio of 10 to 15 stocks, and the way you have constructed is also very concentrated, then obviously you're going to see really uh, in your risk that either your drawdowns would be really high, or the standard deviation or the volatility of these portfolios would be pretty high, even though you produce returns. So I think we take great pride in the fact that we have been able to deliver these returns at a lower volatility as compared to that of BSE 500. Yeah. We follow a totally sector agnostic approach. It totally depends on these market regimes. What sectors tend to get selected, and as you can see, this is the allocation to sectors that we have been uh, having over the past 12 months, right? Currently, we are yeah. Here's the average weight over the last 1 year versus the BSE 500 weight. So last year we have been quite underweight on financials and on IT as well, uh, and we have been quite overweight on these consumer staples and healthcare sector. Right. So this has been the way we have allocated capital to multiple sectors over the past 1 year. Yeah. This is the market cap diversification, and this usually what we follow is roughly about 40%. This year it's been slightly higher, but roughly about maybe you can say 40% in mid cap and 30 each in large and small cap. The large cap allocation has been increasing since last 1 year from 20%. Now it is at about 30%. And yeah, this has been the trend over the past 12 months. Again, this is a result of our portfolio construction approach, and we not don't necessarily try to figure out on our own what should be the market cap of these portfolios that we have allocated to. Yeah. And this is how long alpha adapts to changing market conditions, how much weightage we have given to multiple factors over the past 1 year. So as you can see, momentum over the past 1 year has had close to zero allocation. It's only in the last 3 4 months that we have had some allocation to momentum, whereas quality over the past 9 months has had very good allocation, but only now we have now reduced it to close to zero now. So that's how on the basis of every month we figure out the regime, and then on the basis of that we allocate weights to these specific factors. Yeah. So that's about it from my side, Akshara.
Yeah.
So
Thank you.
I'll stop sharing my screen and happy to take questions.
Yeah. Thank you. It was an insightful presentation more about Estee. Of course, let me start off with that because the PPT had more on Estee's approach. One of your slides said that it's a multi-factor approach to consider portfolio. So how do you prioritize the weight of the factor if two or more factors are conflicting for us and giving a same signal? So how do you weigh it?
So Akshara, what happens is when we have these factors, what we try to do is in the regime estimator we try to select only a few factors that are more likely to work. Okay. And in those factors, it might so happen that, let's say, one factor is giving a very positive sign or positive score, whereas in the other, it might be a negative score, right? So what we take is a consolidated score, right? So it could happen, let's say, what could happen is a stock which is very, very strong technically, but fundamentally it's not as strong, right? So it will have, because of that technical, because it is strong technical, it will have a very strong technical score, high technical score. and it's going to have a very average fundamental score versus any other company which is having above average fundamentals and very strong technically. So that will tend to get selected over the first one, right? So it's a consolidated score that we use. All of these factors that are selected, on the basis of that, we'll arrive at a consolidated score. And then on the basis of that, we are going to select the stocks.
Okay, so that the human intervention is there.
No, no, exactly. It's not human. This is everything is rule based.
Okay.
Right? So we arrive at consolidated score, and using that consolidated score, we pick the top stocks and then we assign weights to it so as to minimize or optimize for the highest risk adjusted returns. So at no stage in this process, human interference is there.
Perfect. And one more follow-up question that I want to ask you is that, there are a single factor approach, a single factor strategies like momentum, which had gained popularity, due to their simplicity now and in more appealing thing. What would you say is the biggest misconception for investors to have to think about what is a single factor strategy when compared to a multi-factor strategy like yours?
Okay. So here, what I would like to point out is, let me tell you a small story. So Akshara, there was a person who was, let's say, 5 feet tall, and he wanted to cross a river, right? And that river was, on average, he checked, that was only 4 feet deep, right? Is that information sufficient for him to cross the river? Obviously not, because what we are talking about is the average depth of the river. But what we actually want to know is, at its deepest, what is the depth? That is more important or equally important, right? So I think similarly with any strategy, what we see, the first thing that we see is the average. What's the average it has given over the past few years? And you told me, and it's right, that momentum tends to give the highest average returns over a longer period. But what also happens is, during the stressful times, during bear markets, when the markets are falling, these are the stocks which tend to have the highest drawdowns also. And you would have seen in last year, prior to last year, when mid caps and small caps were rising, some of these stocks, the stocks which were in momentum, the railway stocks, defense stocks, they were giving phenomenal returns. But we've also seen these stocks have corrected much, much more than the average market, right? Some of these stocks have even corrected 40-50% as well, right? So the important point to note in momentum strategy, which is a single factor strategy, is, although it's a very good strategy, yeah, but during times of crisis, it's going to have higher than usual volatility and higher than usual drawdowns. If one is okay going in actually going through those drawdowns, then it might be a good strategy. But not every investor can actually really go through that kind of volatility and keep on holding to those portfolios. So I think if you see the drawdowns or volatility, then they might not appeal to every investor.
Okay.
Especially these momentum funds.
Got it. I think, but well, what is my question is not fully answered yet. So, what do you think would, from an investor perspective, what would be a misconception for that? Because of course, having a single factor strategy, it might have its own, volatility and drawdown. But what kind of a misconception do you think the investors are having in this current market situation?
Sorry, I'm not sure whether I get your question. What kind of misconception investors are having?
This current market situation on this single factor strategy versus multiple factor strategy. So on that regard.
Yeah, see, multi-factor would almost always give you a better risk adjusted returns, right? And see, in order to produce good wealth over long run, you've got to hold on to those specific strategies or investments, right? So if they are volatile, like value was not working earlier, it's only now that value started working. So for maybe about 3 to 4 years, value really did not work well, and all the uh, funds that were actually based on value really underperformed. Now, that is a fairly long period, 3 to 4 years, to actually hold on to any specific fund while it is underperforming, right? And that could happen with any of these single factor strategies. So it's always better with these multi-factor strategies. The best thing is you're always, if you are able, if the fund manager is able to assign weights or allocate capital properly in these multiple factors, then it's almost always that they will have a much consistent performance as compared to these single factor funds.
Got it.
So I think
Now,
the consistency of performance is
hmm.
also very important.
Okay, now that answered my question. And one of your answers, which spoke about the drawdowns, your long
Yeah.
alpha PMS has demonstrated a low volatility and a smaller maximum drawdown when compared to the benchmark, as per your PPT. Correct. So, what is the specific risk management? So here, the risk management plays a vital role. What's the risk management that ST has undertaken? Particularly during this market drawdowns.
Yeah. So there are multiple things. One is I've already spoken, that is a part of risk management, I believe, because we are using these 130 factors. So it's a well-rounded strategy. I think that is the first layer of risk management, because if you use a single factor versus a multi-factor, single factor obviously would have much higher volatility, right? So that is the first layer. Second layer is that we rebalance our portfolios every month. So obviously there is a slightly higher churn, which is a cost attached to it. But the important thing is it really helps us in risk management, like, because we rely on data and we rely on machines to process that data, make sense of that data. We are able to act faster, and that is why on the monthly basis we are able to revamp our portfolio. So that actually helps us in our risk management. So I don't have the data right now, but from what I remember, some of the best stocks over the last 1 year have given 50, 60, 70, and few funds, few stocks, we were able to extract almost 80 to 100% also in last 1 year. So this is, I'm speaking about some of the best stocks that we have invested in 2024. Versus if you consider some of the worst stocks that we have invested in, the bets that didn't go right for us, what we lost was of the order of about 15 to 20%. And why did this happen? This happened because we were rebalancing on a monthly basis. We were very quick to exit a stock if that specific stock wasn't really working for us. So this frequent rebalancing actually helps these quant strategies in the risk management. And
Okay.
thirdly, the point is we are very, very diversified. I don't know any other PMS which has about 80 stocks in it portfolio. So the kind of performance that I have just shared, the kind of alpha that we have generated, about 15 to 16% alpha that we have generated over past 5 years annualized, we have produced it using about 80 stocks in our portfolio, which is obviously a very, very diversified portfolio. I don't know of any other PMS which has this kind of diversification.
Well, it's a very long diversification again.
Exactly.
Okay, and one more, when you talk about multiple factors that that you're going to consider while selecting a stock, there is a lot of retail participation in recent times. So how does this factor, like for example, the crowd-driven anomalies or investor sentiment, that also that also helps in fluctuations. It's also considers a factor that helps in fluctuations of market or stock prices here. So how does this factor implemented in your model?
I think this is I think this is purely momentum as a factor, right?
Okay.
So if a crowd is getting into a specific stock, it will be reflected in its price and in its momentum. So
Yeah.
if you have defined your momentum factor well, it will be able to capture this specific sentiment. Although there are other ways also, and the other ways is, and that is something that we haven't implemented yet, but we are researching on those factors, like trying to figure out the sentiment analysis quantitatively. So if people are talking about a specific stock either positively or negatively, you should be able to determine the tone of those conversations and use that in your methodology, right? So that is something that we are currently working on. We don't believe till now, we don't believe it can, or at least we are not able to produce enough differentiated alpha using those specific methodologies. But that is something that we keep researching on, and if something really works for us, which gives us some sort of advantage, either in terms of risk minimization or increased returns or even reduced churn, that is something that we are going to do. But many of these things that we talk about are already directly or indirectly getting captured in these 130 factors that we use.
Got it. And one of your slide that said, quality as a factor has zero exposure as of the month of December.
Mhm.
So can we take it as like, ST is predicting the quality as a factor to underperform in upcoming months, and that's why your exposure is zero?
Yeah. So, but the important point to consider here is that we rebalance our portfolios every month. So for the month of January, we do not have any exposure, but when we rebalance at the start of February, we might have some exposure, right? So whatever you are saying that we have taken a position, our view is, and our holding period is typically about 3 to 4 months. So whatever you are saying on the basis of our portfolio would stand true for, it's a fairly short term, right? 3 to 4 months.
Yeah.
So it would stand true for maybe close to 3 to 4 months, but then it keeps changing. It can change quite dramatically over the 3 to 4 months period.
Yeah, having a portfolio with 80 stocks, which is more diversified, and also, other hand, you churn your portfolio as well, and you go for a monthly rebalancing as well. So, how do you handle these both? Because the churn ratio is always proportional to the tax paid for the investors as well. So,
Yeah, yeah.
how is that? Because
So we,
especially
Akshara, we do take into account when we design, and that's, I think, the beauty of quant strategies, that you can take these factors into account. So what we are, obviously, when I said ki we optimize for better risk adjusted returns, so we are taking risk into account. What we also do is, I haven't spoken about two things. One is the liquidity, and second thing is the tax rate. So we do take this also into account while designing our strategies. How do we take liquidity into account? Liquidity, let's say two stocks having the same consolidated score. Okay. Uh, Now, ideally, they should have the same weight. But at the end of the day, what I've got to see is when I go in the market and execute those orders, the one which has lower liquidity I would encounter more slippages there. So at the end of the month, after execution, we are going to have lower returns in that lower liquid stock, right? So what I'll do is I'll slightly penalize that stock because it is having lower liquidity. So that is a feedback mechanism into the whole methodology. And I do penalize those stocks which is having lower liquidity, because when I transact, I'm going to encounter more slippages. And the second thing that I haven't spoken about is the tax rate also. We do take into account these tax rates. So this methodology that I've spoken is the broader methodology. Now we do have the long alpha PMS is constructed of two or three different kind of portfolios. One is this only, but one we have constructed a slightly longer term portfolio also, in which stocks are held for close to 1 year or 1 year. So we rebalance that specific portfolio 1 year. Now, when these tax rules were changed, after that, what has happened is, and this has happened, this is just going as input to our system, that this is my short-term capital gains tax and this is my long-term capital gains tax, right? So what has happened is after that, my allocation to that longer term portfolio is actually increased, which has helped me obviously in a lower transaction cost, but also the kind of profits that I was earlier getting in long term capital gains. Now I'm getting a bigger share of my profits. But having said that, I think it also uh, reduces our alpha generating capability. So the longer you hold to your stocks, the lesser you rebalance, it will actually impact your alpha negatively, right? So I have to balance these two things, right? So obviously you'll end up paying lower taxes, but what's the point if you are getting lower alpha only just because of that, right? So I do keep a balance of these two factors, how much to hold for long term and short term, and then accordingly I design my strategies. So even these are being used as inputs. Uh, Again, this is not something that I am deciding. This is again going as input to this algorithm, which is telling me how much to hold and for how long.
Got it. And when you talk about your portfolio and its holdings, one of your top holdings is like Nestle India and AP and Apollo Tubes. Of course, these stocks name which I've taken is not for any stock recommendation from either from Estee or PMS Bazaar, but still, I could find there's a strong bias towards consumer staples and materials is what I saw from your top holding. So, how do you balance the growth opportunities with defensive positions in this constructing the portfolio?
So again, I think this is a factor of market regime. Okay, so what would happen is typically, I'm just giving a broader example. In the rising markets, typically what would happen is the factors that are given more weightage are the ones that are more aggressive in nature, which means factors like momentum, factors like growth will tend to get more weightage in the rising markets, and accordingly the companies will get selected. Whereas in volatile times or downward sloping markets, what would happen is defensive factors like value, like low volatility tends to get selected, which helps us select stocks which are more defensive in nature. So it is actually the result of the market regime and how our algorithms are designed. Right. So our portfolios, if you see our portfolios when the markets are rising, they will typically be very, very strong rising stocks. So mostly momentum stocks. Whereas in sideways market, there'll be a shift to these defensive stocks. So this happens automatically via our methodology.
Okay. So still, there's the one question that comes into every investor's mind is that past year it was quite tough for Quant to perform as a fund. And I'm just keeping it very broad and very general.
Mhm.
So what would you think, has led to this, quant funds, to underperform when compared to other non-quant multi-cap funds?
See, one of the reasons could be the reliance on single factor methodology. That is one of the reasons. Second is, I think it could be that when you launch a fund, right? Most of these funds were launched in last one and a half, last 1 to 2 years only, right? Most of the
Yeah.
quant funds have been launched, and I think there's a fair bit of learning curve when you actually do anything new. Fair bit of learning curve as to how you design these strategies, how do you risk manage your portfolio. It's quite a different skill set as compared to the discretionary manager. And if you just designed it and not designed it well, you have overfitted your models, that could actually result in having very good looking backtest. But in the real market, you would actually struggle to produce the similar kind of results that you were getting in the backtest. So I think it's a mix of experience, mix of the right kind of skill set. And yeah, I think those would be the things I would say. If you look at someone who has been in this market for long, uh, I don't think really they have underperformed. Uh, the more experienced players in this quant world have done fairly well even in last year. It's, I think, most of the newer ones that have struggled. Yeah. So that's my take on it. Yeah.
Yeah, but even the quant funds have increased in India for past 2 3 years now. At least for last 4 years is what quant funds have got increased.
Yeah.
Um, and moving on to one question that I want to ask was about the cash calls. Because
Okay.
generally, for even in a PMS versus human, yeah, when they predict a market downfall, they immediately go for a cash call. They don't deploy their most of the money. But when compared to when in a quant model, well, the model doesn't say to sit on cash generally. There, the human intervention is still there in any quant fund. So how do
But
you take
Akshara,
on
I
that?
think there are different kind of quant funds. Like there are different kind of discretionary funds. Some fund managers would never like to sit on cash. They are always deployed fully. Whereas other discretionary managers do take cash calls. I think similar is with quant funds also. There are certain quant funds which do take cash calls also. We believe that we are not very good at taking cash calls. We are very good at figuring out, no matter the kind of markets, we believe we are good at figuring out the investment opportunities at that point of time so as to outperform. So our performance is not measured on the absolute sense but always relative to market. So if the index has gone down 10% and if I have gone down just 2%, I have done a fairly good job, right? So coming back to this specific topic, we don't really take these cash calls. We haven't been very good at it, but what we have been good at it is producing relative returns.
Okay.
So regarding cash calls, why do we take cash calls? We take cash calls to reduce our risk during that some period of time, right? But we have actually built this specific thing in our system that whenever markets are not good, we actually, the way we select stocks, we actually tend to select only the defensive stocks which don't fall as much, right? So we are actually reducing the risk. It's not that we are not reducing, even though we are not never sitting in cash, but it's not that we are not reducing the risk. We do reduce risk by way of selecting those safer sectors, those safer stocks. So we do reduce risk because, see, taking cash call is only half the story. You've
Mm.
taken cash call, but the other half of the story is when do you deploy that money back into the system, right? If you have taken a very good cash call, but you have been late in deploying it back, then it's of no use, right? So it's not it's fairly straightforward to say that I take cash call, but it's not that straightforward or easy to implement that, right? But we, having said that, we definitely do reduce risk when times are not good,
Got it.
and that
And
is inbuilt into the system.
yes, got it. So, moving on to the question which is asked by Sagar. A stock might reflect multiple factors, let's say value and momentum. How does your model handle such cases? And additionally, if your resume indicates suggest value bias, what would such stocks be ignored?
So if it has yeah, so let's say if I'm giving zero weightage to momentum,
Hmm.
and I'm just taking these two factors. So your overall weightage would be 100 divided between value and momentum,
Yeah.
right? So if I'm just giving zero weightage to momentum, so I'll actually ignore all the momentum factors. So even though that stock might be in momentum, but what value is telling me is that it is a fairly undervalued stock,
Hmm.
right? It is a and value is currently working. I'm so bullish on value as a factor that I've given 100% weightage to value, right? So in that case, I'll actually ignore the momentum factor and I'll just rely on value as a factor to select the stocks. Even though that stock might be momentum, but still what I am seeing is it is a fairly undervalued stock. That's
Okay.
what matters for me at this stage. So I'll actually ignore all the other factors.
So the allocation of the to that particular stock was also determined at that point of time, sir.
So yeah, so I'll select on the basis of my consolidated score. I'll select the top stocks and using the past volatility and return data of those top stocks, I'll assign weightage to those stocks so as to construct a portfolio which gives me the highest risk adjusted returns. That's how it is done.
Okay. So moving to the next question from Ronald is that how about corporate governance is quantified and how human expertise can be enhanced by an AI?
So one is, yeah, see, corporate governance, there are certain factors. Over long run, I think corporate governance do tend to reflect in the fundamentals of a stock. over long run. But one of the factors also is, let's say, the kind of auditing firms one is selecting. So let's say a company has selected a very good high pedigree auditing firm versus another company having selected some unknown Lala auditing firm, right? So if you just take this factor into account, the quality of your auditing firm that is selected, I think that tells a lot about the corporate governance. And you can actually see this in the results also. So if you just select top 50 or select all the stocks which have the highest pedigree of these auditing firms who are auditing their financials versus the ones who are not, who are using unknown firms, I think there is a difference in the kind of returns these stocks are producing. So that is an indirect indicator of corporate governance,
Sure.
right?
Thanks.
So yeah. And what was the second question?
No, it was the involvement of AI into that.
Yeah, see, involvement of AI, we haven't really included any AI model yet in our systems, but we are do testing. We do test. So see, the problem is any new factor that we have to include, it has to improve our system. So even though it is giving good returns, but incrementally, if it is not having any impact on our portfolio, we will not select it, right? So, and that's what the case has been till now. Obviously, there are a lot of talks, and we have worked a lot on figuring out how best to use AI. I think overall in business processes to run our company, we are using a lot of AI. But specifically in portfolio construction, we haven't really seen any till now. We haven't seen any really advantage of including AI, but we do are working a lot on it. It's only till now we haven't included anything. It hasn't given any advantage in the portfolio construction approach. But AI running our business, be it our retail investment advisory or PMS, we are using a lot of AI to improve, make our systems more efficient. So yeah, that's where we are currently in the usage of AI.
Yeah. Thank you, sir. With that, we have come to the end of the session. And there are a lot of questions was not taken, but still these questions will be mailed to you. And I request you to answer them and send them back to the respective people. And
Definitely,
also there
I'll
are a
be more
few,
than happy to
yeah,
answer to these questions.
yeah, and also there are a few questions which was already answered while you're presenting the PPT as well. So it's a mix of both. Thank you for your insightful presentation, and also we could learn more about long alpha today. Thank you, sir.
Thank you, Akshara. Thank you for having me. It's always good to speak to you. Thanks a lot.
Thank you.